The increase in taxes on superannuation balances above $3 million begins on July the 1st next year. To discuss the changes, John Van de Pol from Morgans joins me now. John, thanks so much for being there. So let's go through the main changes that were outlined by the federal government.
Yeah, morning, Sue. Some really fantastic changes that the industry's pushed very, very hard for. So we've still got the original discussed tier of or threshold of $3 million, and effectively any earnings that have been generated by the fund are going to attract in proportion an extra 15% tax above the existing 15% tax. But the government has also introduced an additional threshold of $10 million, which will be subject to up to 40% tax on the earnings for the financial year. The other big changes that we're really positive about is this: we're back to normal, the normal tax effect, which is we don't tax people on unrealised gains. That was the really big stumbling block that the industry was struggling with. So it'll only be on realised gains. And also we're going to have indexation, which is going to be linked to the transfer balance caps. So a much fairer set of changes than we originally were being told by the government.
So if the original proposal was kept in place, what would be the implications?
I think, talking to clients, they're certainly looking, well, how do I exit superannuation? How do I get my balance down to a level where I'm not going to have these problems? And the big stumbling block was definitely this tax on the unrealised gains. We deal with a lot of clients who have property in super fund. We've got agricultural families, farming families. It just wasn't that easy. They'd have to literally be selling the farm to be able to fund the liability. So it's fantastic, and full credit to Jim Chalmers and Treasury that they've actually listened to the industry and taken on board our concerns and have provided us with a much more workable system. Legislation still to go through. We should say to everyone listening, don't act yet. The legislation won't be going in Parliament until probably early 2026. But the starting the starting date is the 1st of July 2026. So hopefully plenty of time for people to get their arrangements in place.
Now you say that the indexation will apply to both these thresholds to maintain relativity with the transfer balance cap. So can you explain that?
Yeah, so the transfer balance cap at the moment is effectively the amount that you can actually commute to pension. So that currently stands at $2 million. There's also, for the concessional and the non-concessional caps, there is also increases, indexation that goes through every couple of years. So at the moment, the concessional cap is $30,000. And the non-concessional cap sits at $120,000. So every couple of years, it's not every year they get indexed. So with the $3 million threshold, the next time we get indexation, it will be an increase of $150,000 will be applied. So that will go from 3 to 3,150,000. And in the case of the $10 million cap, that's going to increase by $500,000. So that'll go up to $10,500,000. So again, much fairer, and certainly in the case of the $3 million threshold, really relevant to younger people entering the workforce today, because they were the ones who really stood to lose out of this. It won't take much with mandated contributions and someone working for 30 years to breach a $3 million cap.